Welcome to Cash Flow Planning and Cash Budgeting video. In this video, we will explain the short-term and long-term cash flow planning and describe the concept of cash budgeting. After going through this tutorial, you must be able to differentiate between short-term and long-term cash flow planning, construct a cash budget. We now know that how important is financial planning. The base of any financial planning is a cash flow projection. Without an accurate evaluation of cash flow, the entire financial planning exercise becomes futile because cash drives all the related initiatives. Cash flow process involves cash inflow and outflow. Cash inflow refers to incoming cash. Cash outflow denotes outgoing cash. Next, let's look how to balance these two cash flows. The main idea of cash flow planning is to balance expenses on life goals with the available income. The excess of cash inflow provides a buffer for meeting various expenses of an individual. However, if cash is not sufficient to make the cash outflow, it is an indication of debts. Hence, few stringent actions are required to balance between the two cash flows. Further, cash flow planning is classified into short-term and long-term. Next, let's discuss each one of them in detail. Short-term cash planning is one of the most important components of financial planning. It helps to identify and deal with the temporary or short-term cash shortages or surplus. It includes cash inflow and cash outflow for a short duration. Such cash flow planning is for maximum 3 to 6 months, though this time period may vary for each individual. Let's take an example to understand this term better. Let's understand the data present in the table. This table shows short-term cash flow planning for 3 months. From the data, it is clear that cash outflow is dynamic, whereas cash inflow is static. There are certain components in cash outflow that can be controlled or regulated. For example, the household expenses can be controlled by decreasing unnecessary expenses. However, school fee is mandatory. Thus, the judicious use of the cash flow provides a good tool for managing funds. Next, let's look at cash flow cycle. Cash flow cycle refers to the movement of cash and money in a business or an individual's financial accounts. From the short-term point of view, a financial planner should first identify and analyze the short-term cash flow cycle of a client. Based on this cycle, he should define strategies to speed cash inflows and reduce and optimize cash outflows. The cash flow cycle is calculated using a formula. Cash flow cycle is equal to average age of inventory plus average age accounts receivable or AR minus average age accounts payable or AP is equal to number of days in the planning period. Here, average inventory is equal to inventory at beginning minus inventory at end divided by 2. Average AR is equal to AR at beginning minus AR at end divided by 2. Average AP is equal to AP at beginning minus AP at end divided by 2. Now, let's see benefits and use of cash flow cycle. Analysis and calculation of the cash flow cycle helps the financial planner to ensure if client resources are effectively utilized. Such cash flow statements and cycles also help to forecast the business investments to achieve the financial goals. These cash flow forecasts include the following benefits and use. Utilizing cash efficiently. The financial planner who accurately forecasts cash flows can optimize the expenses and use available cash effectively to generate cash surplus. Short-term and long-term borrowings. A well-defined report of all income and expenses. The financial plans are drafted accordingly, including the best combinations of short and long-term borrowings to optimize the costs of interest. Finance for expansion. A good financial forecast helps in accumulating cash and funds for expansion well in advance. Cash discount advantage. On excess cash available, the financial planner can suggest a client on trade discounts or discounted sale or bulk purchases at cheaper rates. Estimation of debt capacity. A cash flow forecast helps in assessing a client's capability to pay interest. Thus, helps in determining the amount of debt that can be safely incurred. Formulation of dividend policy. Cash flow forecast also helps in making decisions on the dividend policy. As now that we have learned about short-term cash flow planning, next let us learn long-term cash flow planning. The long-term cash flow planning is generally about 2 years or more. It aims to help an individual meet objectives and goals in life, which might be retirement plans and children's higher education. It involves planning and analyzing the long-term assets, investments, and expenses, make long-term decisions, which are called capital structure decisions. Let's take an example to understand long-term cash flow planning. From the above table, you can see that unlike short-term cash flow planning, there is practically no scope for modifying or regulating the cash outflow components due to their stringent nature. However, it all depends on each component. In such a case, a positive income shows that there is a scope for investing in good portfolios to make revenues, while a negative balance indicates the individual's debt commitments. Now that we have learnt about types of cash flow planning, let's take a look at cost budgeting. Cash budgeting is another process to manage the finances of an individual. A cash budget is an estimation of the possible cash input and cash output of an individual over a specific period of time. It depicts the possibilities or estimated projections of cash inflow and outflow. Since it is a projected estimation, there might be significant variations in the actual values. Cash budgeting helps to avoid a cash shortage when expenses are on the increase. Let's take an example now. The above table shows an evaluated statement that considers the projected cash expenses and income. Such a cash budget enables an individual to analyze the cash availability and the expected expenses. This helps to make necessary investments for achieving financial goals and avoid liquidity. Now, let's summarize our learnings. The summary of the tutorial on cash flow planning and cash budgeting has been put on the screen. I will pause for a few seconds to allow you to read it. Using short-term and long-term cash flow planning, plan your financial planning wisely to achieve your life goals at a faster rate.